Hello and welcome to this session in which we would look at the type of opinion that could be issued by a service auditor in a SOC engagement. So the opinion expressed by a service auditor in a SOC engagement are based on the evidence collected during the engagement and may include the following: unqualified opinion, qualified opinion, adverse opinion, and a disclaimer of opinion. Now real quick, who's the service auditor? Well, let's assume Farhat Lecture. I am a user, they called me a user entity. I am in the online education business. So what I do is I outsource my IT support to another company. So the IT support is my service organization. Now, this is the service organization. Now, this company will hire an auditor, and this is the service auditor. I want to make sure we're all on the same page. So the service auditor is the auditor that audit the IT support, the IT support company that helps me because I outsources my business to them. In the prior session, we looked at the unqualified, unmodified opinion, the conditions where the service auditor issued this unqualified or modified opinion. In this session, we're going to look at under what circumstances would the auditor issue a qualified opinion, adverse opinion, and no opinion, disclaimer of opinion. And as I always mentioned, you always want to take the auditing exam before you take information systems and control, because these opinions we used in the financial statement audit. So let's go ahead and get started to learn about under what circumstances we would modify an opinion. Modify means don't give a clean, unqualified opinion, modified opinion. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Starting with the general rules. First, to issue an opinion, we have to have evidence. Well, if we cannot collect evidence, so lack of sufficient evidence gives us a modified opinion. Modified opinion is any opinion other than, you guessed it, clean, unqualified. So lack of sufficient evidence refers to a situation where the auditor cannot obtain the necessary information, which is evidence, to do what? To assess whether the controls or processes meet the specified criteria. And why wouldn't the service auditor be able to do that? Well, it could be many reasons. It could be limitation in access, where the service organization, they're not giving them access. Scope or cooperation from the service organization. Basically, the service organization is limiting their work. They're not giving them what they need. They're not cooperating, which prevent the auditor from getting a clear and complete evaluation. You're not giving me enough evidence. How am I going to issue a clean opinion? So without sufficient evidence, remember we need sufficient and appropriate, the auditor cannot conclusively opine that the subject matter is managed according to the established criteria. Well, if I don't have the evidence to make a judgment, at least I cannot give you a clean opinion. So that's one reason where we could modify. Now, whether we give, what opinion do we give? Is it a qualified, adverse, or disclaimer? We'll talk about this, but generally speaking, we're looking at evidence. The other issue could be that the service organization is not in compliance. So non-compliance criteria indicate that through the evidence collected, now we have the evidence, could be another reason why we modify an opinion, we have the evidence. However, the service auditor has determined that the service organization system or control do not align with the required standard or criteria. Simply put, they are not following what they say they're claiming. For example, they don't have a good, their description failed, or the suitability of design failed, or their internal control over financial reporting is not working properly. So this misalignment may be due to failure in design, implementation, or operations of the control. Remember, failure in design and implementation, usually that's a type 1. Operations is a type 2. So those are basically the reasons why you would modify. Very similar to the traditional audit. In a traditional audit, we discuss the same concept. Evidence is one, and basically the other one is GAAP. So in auditing, in the traditional auditing, I hope you remember this, it could be a GAS issue, generally accepted auditing standard, or it could be a GAAP issue, generally accepted accounting principle issue. And this is what we are looking here if we want to draw parallels, comparison to a SOC engagement versus a traditional financial statement audit. So when we are looking at a SOC 1 engagement, remember SOC 1 deals with internal control over financial reporting. We will be repeating those terms again and again, and it's good for you. If you're studying for the CPA exam, you want to associate SOC 1 with internal control over financial reporting. In SOC 1 engagement, the auditor modification to their opinion are crucial to signal to stakeholder the areas where the service organization systems and controls may not meet the standard required criteria. What are they? Well, misrepresentation of the system. This suggests discrepancies or inaccuracy in how the system is described. So we have a problem with the description to its actual configuration or functionality. So this can affect stakeholder understanding and reliance on the system. So their description of the system, there's a lot of inaccuracies in that. Or the design is inadequate. This implies that even if the controls were operated as intended, they would still not achieve the control objective. The design of them are not suitable. And this will highlight fundamental flaws in control, planning, or structure. Also, we could have an issue with ineffective control operation. Once we talk about ineffective, we're looking at SOC 1 type 2. Indicate that during the period under review, the control did not operate. They're not operating effectively as needed to meet the objectives. I know we keep repeating those terms, but again, this is part of learning them, raising concerns about the consistency and reliability of these controls over time. And obviously, under SOC 1 engagement, we could always have evidence issue, insufficient evidence, reflect limitation encountered during the audit that prevent the auditor from verifying the aspect of the system or control. So we could always have this issue. So one, misrepresentation of the system and an adequate design of control. This is usually type 1 report. This is type 2 report, and this is an evidence issue, just listed there. In a SOC 2 engagement, basically the same thing. We could have an accurate system description, but you want to understand SOC 2 deals with trust services criteria. Same thing. We could have a type 1 about the description. We could have a type 2, but type 2, inadequate control design as per the established trust services criteria. This is type 1. Those two are type 1. Then we could have a type 2, control operation effectiveness, signals that during the review, the control did not function as needed to consistently support the service organization commitment and requirement, raising concern about their reliability and effectiveness. This is a type 2. And in SOC 2, we could always encounter inefficiency of evidence could give us a problem. Again, I know SOC 1 and SOC 2, basically I think we covered this so many different times, but it does not hurt. Now, which opinion is appropriate? Okay. Now we need to understand which opinion is appropriate. Well, the service auditor decides about issuing a modified opinion. It could be either qualified, adverse, or disclaimer. It depends on two key factors. They look at two key factors. The nature of the matter. This involves determining whether the subject matter align with the criteria in all material respect, or there are issues such as insufficient evidence that could suggest material misstatement. So what's the nature of the problem here? Are we having evidence issues or lack of alignment with the criteria? And this criterion assesses the accuracy, completeness of the information presented. If discrepancies or evidence gap are found, they must evaluate how these affect the reliability of the audit conclusion. So first, the nature of the matter, then the pervasiveness of the effect. So okay, we found a problem, but how pervasive? Pervasive is it limited? Is it limited to a certain area in the company? Or is it affecting many key controls at the company? So the auditor assesses how extensively the identified issues affect the subject matter. How extensive is the problem? Well, this refers to the extent to which an issue are spread throughout the engagement. So the auditor here uses this assessment to decide the severity of the opinion modification. So okay, we have a problem collecting evidence. Well, as to a specific particular control, that it could be important, but only to that control. It could be to a control that's not even important. Or are we lacking evidence and we really cannot cannot really issue an opinion if we're having problem with the criterias. They're not following the proper controls. Is this limited to one area, or is it pervasive? It's a key control and it's affecting many areas. So when do we give a qualified opinion? We give a qualified opinion when the auditor finds that, with the exception of certain areas of concern. So here what we're saying is, a qualified opinion is giving is if everything is good except one area. So a qualified opinion is issued when the auditor finds that, with the exception of certain areas, the system descriptions and control align with the established criteria. This is for type 1, and appropriately designed and functioning effectively if we're looking at type 2. So with the exception of this area, everything else is good. The description, the suitability of the control, and it's working effectively for type 2. So this opinion implies that the issues are isolated and do not encompass, does not cover the entire report. So the issue is limited to one area. To summarize, qualified opinion is issued if the issue are material. They could be material but limited to specific parts of the subject matter, and we can live with it. Therefore, we issue a qualified opinion. For example, suppose a service organization uses a financial reporting system and the auditor is engaged to assess the control over financial data integrity. Well, if the auditor finds out that all controls are effectively designed and operational except for those related to data backup processes which were not adequately implemented throughout the audit period, the auditor may issue a qualified opinion. They are implemented, but they're not implemented throughout the audit period. So they are implemented not as often as they should. So everything else is good except their backup processes. Well, it's limited. This opinion would state that except for the inefficiencies in the data backup control, the rest of the system is presented accurately according to the criteria, and the control are suitably designed and operational. So this is an example of it. Now, if the backup is severe and it's affecting many other areas and they're not really doing any backup, then it's something else. It could be an adverse opinion. An adverse opinion is given when there are widespread significant misstatement in the system description, or when the design and operational and control exhibit material and pervasive deficiencies. It means spread throughout the system. This opinion reflects a fundamental departure from the necessary criteria and suggests that stakeholders should not rely on the stated control or system description, because we have serious issues here, not limited to one area. So adverse opinion is warranted when the issues are both material and pervasive. If they were material but limited, we can maybe give, again, it's a judgment at the end of the day, we can give a qualified. But if it's material and pervasive, well, affecting a substantial portion of the subject matter, you got it, a bad opinion, adverse opinion. Very similar to the, which one? You guessed it, the audited financial statement. So an example would be a service organization processes transactions for client. If the auditor discover that the control related to transaction processing and data security are not only poorly designed, but also ineffectively implemented, and these issues are extensive enough to affect nearly all aspects of the system operation, well, and under those circumstances, I'm sorry, you're going to get, not sorry, you're going to get an adverse opinion. In this scenario, the report would state that due to these comprehensive deficiencies and misstatement, the system's control and description do not meet the required standard in a significant and all-encompassing manner. You're getting an adverse opinion. This informs users of the report that the information and operation detail in it are unreliable across the board. Don't worry, we're going to look at an actual report later on. I'm just telling you here under what circumstances you give the opinion. How about a disclaimer of opinion? Disclaimer of opinion is you're keeping your mouth shut. That's what disclaimer of an opinion. You can't say anything. Why not? A disclaimer of opinion happens when the auditor faces substantial restriction during the audit or encounter uncertainties that profoundly impact the ability to assess the systems or control. Here, I cannot collect evidence, and if I collect it, I'm not being able to do the proper assessment, the proper valuation. Simply put, I don't have enough evidence to say anything. So in such cases, the auditor explicitly state that they are not expressing an opinion on the effectiveness or accuracy of the system descriptions and control. And usually this is like a signal that it's, the company may not be cooperating unless they have a good reason why they could not do it. And sometimes maybe the company is doing an update, the update is not complete, they just do it under an attack, like a cybersecurity attack, and their system is not up and running fully, therefore we could not collect enough evidence. That could be some legitimate reason, but it could be that the company is not cooperating, and that's a problem. So disclaimer of opinion is necessary when uncertainties or the scope limitation are so significant that the auditor cannot form an opinion on the engagement subject matter. For example, suppose a service organization has undergone a major system upgrade during the audit period, and significant portion of the financial data are inaccessible or complete because they're still going through that update. Well, if these limitations prevent the auditor from evaluating critical control related to the financial reporting, they might issue a disclaimer of opinion. So in this report, the auditor would state that due to the incomplete data and inability to perform necessary audit procedures, they cannot express an opinion on whether the system control and description are accurate or effective. Here we're saying we cannot issue an opinion. Nothing is bad. We don't know whether it's something is bad or not just because they underwent this major system upgrade, and we don't have access to the financial data in order to make this evaluation. Let's take a look at this multiple choice question from farhatlectures.com. Which situation would likely result in an auditor issuing an adverse opinion for SOC 2 engagement? So first of all, what's an adverse opinion? Opinion that's no good. No good means the problem is pervasive and material. What is SOC 2? SOC 2 means it's an audit for trust services criteria, security, privacy, availability, integrity, processing integrity. So here what we're looking at is when would the auditor issue an adverse opinion. Let's look at A. The service organization description of the system aligns with actual practices. Well, that's good. I don't see any reason to issue an adverse opinion. Most likely this is an unqualified opinion. That's not good. B. Controls around data security are poorly designed and ineffectively implemented across the system. I would say this is a problem, especially data security. I would say I will keep B for now. Insufficient evidence is available concerning the operational effectiveness of specific control. Well, if inefficient evidence is available, it means not enough evidence, that's an issue, but if it's an evidence issue, we could either give a qualified depending on the severity of the issue, or if we really cannot say anything, we will disclaim. So C is out because of that. Now we're down to 50-50. The auditor disagree with management future operating strategy. It has nothing to do with the SOC engagement. The auditor disagree with their operation strategy. It's not even the auditor's job whether to agree or disagree with them. It doesn't affect the SOC engagement. So the answer, as we suggested, which was clear-cut, a B, what we're looking at in an adverse opinion, the problem is severe, material, pervasive. It's affecting key control, and it's not limited to one area. Those are the words you're looking at to issue an adverse opinion. What should you do now? You want to go to Farhat Lectures, look at additional MCQs, true, false, additional resources that's going to help you pass the CPA exam. We are here to help. Invest in yourself, and of course, stay safe.